Hello, everybody, and welcome to another adventure with our intermediate accounting course. So this is exercise 17-24. So on January 2nd, we purchased a call option for $300 on merchant common stock. The call option gives us the option to buy 1,000 shares at a strike price of $50 per share. The market price of a merchant share is $50 on January 2nd. The intrinsic value is therefore zero. On March 31st, the market price for merchant is $53 per share, and the time value of the option is 200. So when we buy this option, really what we're going to be going through and doing is, okay, so over here, okay, call option. And I think as I'm going through and remembering, like when I've done this previously for other sections and problems, I think what I try to do is I try to basically break this up into two different portions. I'm going to have a call option time value. And then here I'm going to have the call option. And for the time value portion, there's really, so the time value is really going through and referring to I buy this item over here on 1/1/20 for over here for 300, right? So this is going to be my asset. I'm going to go over here and I'm going to credit cash on 1/1/20 for 300. And I want to segregate these two and separate them because this is, I'm going to just use, because as time goes on, right, this is it eventually get down to zero, right? So over here, it basically, this is eventually going to go to zero, but where the call option is actually going to have value is going to be if the share price goes up. So as I look at this here, the journal entry to record the purchase of the call option. Will be over here on 1/1/20. I would debit call option time value, credit cash. And you can just go through here and just put it all in as the call option, but I kind of like to keep it separated, and I'll show you why in a moment. Okay. So then over here, to do the change in the fair value, right? Right over here, and we're only going to do this. So we'll call this call option fair value. And we'll call this unrealized holding gain or loss. Okay, so when it comes to these options, right? So when I get to March 31st, right, what is the change in the fair value of the call option? Well, there's going to be two components. It tells us right over here that on March 31st, the call option time value, the time value of the option is 200. So this here is at 200. So over here, I'm going to have an adjustment for 100. And this is going to be my adjusting here. This is going to go impact my unrealized holding gain or loss. Okay, so this is, I'm going to basically debit, credit, call option time value, and I'm going to debit the unrealized holding gain or loss for 100, right? And this isn't going to be realized until I actually go through and I just essentially sell it. So, or I exercise it. Now, that's just for the time value of the call option. This is eventually going to go down to 0 if we do not exercise the option. Now, here in terms of my strike price is at 50. Okay, the value of the share price on March 31st is 53. So this increase is going to be right here at $3 per share. Now, I take this $3 per share and I figure out what is my option. So my option, or my shares to that I can purchase, or option to buy, I'm going to have 1,000 shares here. So in this part over here, I have option to buy here. So I have an unrealized gain of $3 times 1,000, or $3,000. So my call option fair value is now, because this actually has worth to me, because it's gone up by $3. This option now has value. So I'm going to debit the call option fair value, and then I'm going to credit an unrealized holding gain for this amount. So to go through and to do these journal entries, on 3/31, I would be debiting unrealized holding gain or loss income. And this one over here would be 100, call option time value. And then over here on 3/31, I would have an unrealized, I would debit call option fair value of 3,000. And then I would be crediting the unrealized holding gain or loss for 3,000. Now note, on the financial statements, we would just combine these two right over here to show a total value of 3,200. But I'm splitting this out intentionally so it's a little bit easier for you to go through and see. So those are the journal entries we would be going through and doing for this type of problem. As I look at this now, this is actually a good problem to start up with, just because it's a little bit easier for us to go through and understand. Okay, so let's now take a look at a fair value hedge. So on January 2nd, McLeod issued a 4-year, $100,000 note at 6% fixed interest payable semi-annually. That means it's going to pay 3% twice per year. McLeod now wants to change the note to a variable rate note. Okay. Can you do that? Sure, you can do anything you want, right? It's just there will sometimes be consequences to that. So as a result, McLeod enters into an interest rate swap where it agrees to receive 6% fixed and pay LIBOR of 5.7% for the first 6 months on $100,000. At the end, at each 6-month period, the variable rate will be reset. The variable rate is reset to 6.7% on June 30th, 2020. Okay, so compute the net interest expense to be reported for this note and the related swap transaction as of June 30th, 2020. So let's go through and take a look at this. So the amount, so let's look at these in 2 separate time periods. So the fixed rate debt is going to be 100,000. What I'm then going to do is I'm going to multiply this by my fixed interest rate. And this here is going to be 3%. Why is it 3%? Whenever you see an interest rate, it is always going to be an annual rate. And this is to basically convert it to make it semi-annual. So over here, semi-annual debt payment is going to be over here at $3,000. Okay. So, and over here, we've got a swap fixed receipt. Okay, of 3,000 and okay, net income effect is going to be 0. Okay. Now, what I did do is my variable rate swap, meaning that I took 100,000 times, and I'm hedging this here, so I'm multiplying this by, it was basically set at 5.7%, so it's 100,000 times 5.7% times 0.5, or 2850. Okay. So over here, my net interest expense is going to be 2850. We call this a swap variable rate. So my net interest expense is going to be 2850. Okay. So over here, so that's my new interest expense because I've gone through and I swapped out my interest rate. I agreed, or I got someone to say, okay, we'll guarantee you the 6%. And basically as a result, the interest into an interest rate swap, where they're now going to basically be agreed to pay just 5.7%, and somebody else is going to be responsible for that. Now, when I get to the next 6 months, okay, the fixed rate debt and the fixed interest rate, so somebody else is handling all of this part over here, right? And again, they're going through, and this is kind of the same deal. Somebody else is assuming this. But my new swap variable rate is going to be, this is going to be different because this is now going to be 100,000 times 0.067, because that's my new rate, but I have to multiply that by 0.5. So over here, so this is going to be 100,000 times 6.7 times 1/2. So my net interest expense is going to be 3350. Okay. Okay. As I look at this over here, what I would want to be really careful with is making sure that I have a full understanding in terms of going through and recording this, because if there's any kind of crazy like holdbacks, or if there's any type of language that comes in here that would cause us to have to go back and pay the original amount if we're reporting a lower amount, that would be something that I would want to make sure that I fully understand. And just as another kind of, not necessarily a word of caution, but when you go through and you're taking, if you have clients that are in this type of work, you really have to kind of go through and say like, okay, we really need to go through and understand this before we start going through and doing it. And this is certainly, I would be the first to say that this is not necessarily my expertise, but I am trying to learn, just like you are, and this is really what you'd be going through and doing when you're in the field. Okay, so let's take a look at exercise 1726. Okay, on January 2nd, Pardon Company issues a $10 million note at LIBOR with interest paid annually. The variable rate is reset at the end of every year. The LIBOR rate for the first year is 5.8%. Pardon Company decides it prefers fixed rate financing and wants to lock in a rate of 6%. As a result, Pardon enters into an interest rate swap to pay 6% fixed and receive LIBOR based on 10 million. Okay, so the variable interest rate is reset to 6.6% on January 2nd, 2021. Okay, so let's see over here. So for January 2nd, 2020, okay, the variable rate debt is going to be 10 million. Okay. The variable rate is 5.8%. It's for a full year. So the debt or the interest payment, we call it the debt payment, is going to be 580,000. Okay. So this variable rate, okay, hold on. The variable rate, say, okay, LIBOR rate of the first year is 5.8%. Okay, so this language here is a little bit funky because over here, if it's saying that decides it prefers fixed rate financing and locks in a rate of 6%. So they enter into an interest rate swap. Okay, so this is kind of confusing, but the way your book is showing it is that this 6% is going to be effective as of January 2nd. So this is literally they're deciding like the day after. Okay, so over here, my debt payment is 580, swap, variable received. Net income effect is 0. And then my swap payable is going to be 10 million at 6%. Or 600,000, so the net interest expense is going to be 600,000. Okay. So right over here, then at 12/31/21, the variable rate debt is still going to be over here, but I agreed to go into a fixed rate transaction. The variable rate here is 6.6%. So the debt payment here is going to be 660. My debt payment is going to be 660. However, I'm swapping this out, and my net income effect is going to be 0. However, my swap payable, meaning I'm having to go through and pay the fixed amount, is still going to remain at 600,000. And that's how we're getting to this value right over here. So I don't pay because I agreed to do this 6%, and this was at the very beginning. If LIBOR goes up, I don't have to go through and to pay that. As I'm looking at this right over here, when we're looking at cash flow hedges, I think that probably the more disclosure you can have, it's going to be the better, because as we go through and we look at things like this, because if an investor is saying like, oh, I'm going to invest in this company, and they see the interest expense, but it turns out to be variable, and if the interest rate goes up, that's not going to bode well for that company. So in any event, I want to thank all of you for joining me here today on Accounting 202A, A Space Odyssey. And I look forward to seeing you on the next video. Have a great one.